Welcome to Dividend Talk, episode 236. 5 top consumer staples for your consideration with Alberto.
Hello, Alberto, the new Derek. How are you doing? For the listeners that don't know you or may not remember you, if you could say in a few words who you are.
Hello, how are you doing? I'm going to be substituting Derek from now on, so he's no longer a member of the podcast. I'm joking, obviously, but he won't be here today. For many of you that probably don't know me, actually I was attending a previous podcast 2.5 years ago. But I'm Alberto from Spain, and I've been investing mostly in dividend growth stocks for over a decade now. And I used to have a newsletter with some friends, which was Cartas del Dividendo, that if you are Spanish, you probably know. And I don't know. I can't think of much else to say. I think that we are going to have a lot of fun, and I'm really grateful that I was invited here again by these great friends.
Of course, Alberto, and we are going to have fun because, the dividend hikes and such, we'll talk soon about that. Yeah, but I think you do pretty well. Probably for some of our listeners, you're easier to understand in English than our friend Derek, who is an Irish citizen. So he's Derek, if you're listening, we'll continue joking probably about you through this episode. You deserved a little bit, but jokes aside, he is having he is having a great weekend with his family. And I hope you enjoyed this one, Derek. Well deserved. I know how busy you are, so you also need this sometimes, and I really appreciate you as a friend, because this is like what it means, family first. And I'll have you back next time. He will have my back. But Alberto, it just was quite nice when I posted that you would come onto the show to see those positive reactions. So clearly people love listening to you, and I hope our listeners will also again see why today. But maybe to straight away with that, go into the news, Alberto.
Great.
Have you seen this thing about Unilever and the CEO suddenly stepping down?
Mm-hmm. Yeah. To be honest, quite surprising. I guess you probably are surprised as well, because the stock did mostly quite well, and they changed the course of the company. So it really seems that he was fired, although we never know. But at the same time, I know that the CFO, that it's going to be the new CEO, was very, very well regarded by many investors and many analysts. I listened to him in the last Capital Market Day of the company and some of the latest result presentations, and honestly, I liked him and his approach very much. I have read in the press that some people were suggesting that since the previous CEO had completely disregarded the possibility of big acquisitions, that maybe this could lead to Unilever making a big acquisition again. Like a few days ago, there were some news that maybe them or Procter & Gamble were going to buy Kenvue, and a few days or maybe today, Helion as well. There were some rumors, but honestly, I think that's unlikely. I don't think the new CFO is going to change that, because I think he's got very clear that organic growth is the way to go, and focusing on Unilever's power brands. So I don't think there are going to be big changes in the company, but you never know.
Yeah, and El Kuba was asking about that as well, because he sent in a question. He said, like, is this a time to do some spin-offs like General Electric actually did? And if we look at General Electric, they did quite well, right, over the last 2-3 years with those spin-offs.
Mm-hmm.
know they're trying to figure out what to do with the ice cream business. But for me, it's a very interesting case because, I mean, the former CEO before Heinz Schumacher, he was really Alan Yopi. He was really like a droopy. I mean, he wanted to buy, was it Helion, right? For
yeah, when it was still within.
Yeah,
right?
that would have been at that time probably the nail in the coffin, right? For Unilever. So to your point, I finally see that underlying growth is coming back with the new CEO. So I'm so surprised that that he stepped down. In my opinion, it's clear that the board or the investor probably the activist investor didn't want him anymore. So. And I'm surprised by that. But hey, we don't know what's going on there. Maybe he was a bit too much Dutch in his directness, and that they felt like, okay, we just need a CEO that does what we ask them to do. Maybe the CFO seems to be more such a guy. I don't know. That's a pity. It's a pity. He was really putting the strategy in place. We could see it. We saw it turning back to growth. The share price started to respond. That there was really positive momentum around Unilever in the last year, I would say.
Yeah. But to be honest, the share price didn't drop significantly with the news, which is something that usually happens when there is a sudden departure of a CEO. And I think this is a proof that probably a lot of investors like the change or have a high level of trust in the CFO.
Yeah.
So I like Unilever quite a lot, to be honest. I think the company gave a very good opportunity to add shares in this past few years, and I think they are going to have much better years ahead now. I think the ice cream separation makes sense because it's a bit different to the rest of the business. It's not very, it doesn't have very many synergies, although I do not like that word that much, but it's a business that it's seasonal. It needs like a cold, which is different from their business. And it has, I think it has also a different board of directors. So it's a bit of a complex matter. I think once it's separated, the company will be more focused on their power brands.
Yeah. Good. Yeah, it's a large holding in my portfolio, so I felt always like it was a bit of my sick child, but now it returned back to a healthy one, I would say. But Alberto, one of the things we do, and specifically this season is always really nice, it's dividend announcements. And I mean, so many European companies this week. Let me go through them, and then I would love to hear like some thoughts about maybe a few of them when you see them. And that my listeners know probably that I'm a big fan of insurance companies. And last week we had an N Group and ASR Netherlands both giving an 8% hike. But then Munich Reinsurance came and said, hold my beer, a dividend hike of 33% to €20 per share. Oh my God. This is one of the stocks that I wish I bought more of at that time. And my average cost price is around €150 or €160. I mean, could you imagine an insurer that you look like a few years later and you say, well, it tripled in value and in share price? It's amazing.
Yeah, it's crazy also because if I remember correctly, I think they did a 3% hike last year.
Yeah, they also did a big hike,
Yeah, so I mean, to do such a big hike one year is very unusual, but to do it 2 years in a row, it's quite crazy. And I was just checking real quick because I also feel like you that I would have loved to have a bigger position, but my average cost is 242. So I think yours is even lower, which is good for you. But yeah, in insurance companies, we will mention some other dividend hikes. European insurance companies are delivering this year for sure.
Because I saw a comment on Twitter where I said like, I know only this 1 to 3% hikes, but let's go on then. Allianz 11.6% dividend hike. Chubb, Swiss company, can we say that? Probably 6.5% dividend hike. AXA 8.6% dividend hike. Any other here? Ageas, 7.6% dividend hike. I mean, insurers are on fire, really.
Yeah.
And by the way, on fire, Munich Re is, of course, some exposure, I believe, to California and forest fires, right? I mean, let's say it like that. You could say it's a bit of a sin stock here, because now they can ask much higher premiums in California, right?
Mhm.
So that's a bit the dark side of this. Once such event hikes happens, people are more willing to pay more for insurance after that, and the probability for it to happen in the same spot twice is, of course, very low again.
Mhm.
So there's really an uptake for companies here. And also my car insurance, I just renewed it, so I'm not surprised that Allianz was doing a dividend hike, because our insurance policy hiked by 10% this year. And I told my wife, sweetheart, don't worry. Usually, if the car insurance is going by 10%, I will get like at least a 10% dividend hike. Here it is 11%. So it is really funny.
Yeah.
It's really funny.
Actually, yeah, Allianz guided for earnings per share growth until 2027 between 7 and 9%.
Mhm.
So I think it's quite likely that there will be some very good hikes in these next coming years as well.
Exactly. And I've got now a lot of insurance in my portfolio. But hey, then another one that I'm really a big fan of, Iberdrola, hiked
Mhm.
the dividend by 15% as well. I mean,
Yeah.
we talk a lot about oil and gas, but this little beauty there is also doing an amazing job.
Yeah, to be honest, Spain has historically had quite a few of utility companies, but I think Iberdrola is clearly the best of them, and I think it's very reasonable to say that it's probably the best European utility.
I would argue the same. I would argue.
Yeah, these last few years, the company performance and of course the dividend hikes have been amazing. So obviously I wouldn't expect 15% hikes going forward, but I think it's a very well managed company, and I think they have been doing things very well
Yeah.
these past few years. So I have good expectations for them going forward too.
I was always looking into them in the past, but they had a dividend cut, like, was it 10 years ago or something like that? So I was shying away from it. And then I did a deep dive last year.
Mhm.
And when I really understood what this company is about, and it has also some exposure in Latin America, right?
Yeah.
When I understood that all, I felt like, oh my God, why didn't I own this one much earlier already? But that's the thing, right? Sometimes you need to really do your homework to really get to understand the company.
Yeah, and also there are many very interesting companies, and of course money is limited, so
Exactly.
you can always buy everything that you would like to, but
Yeah.
yeah, it's a very good company.
Hey, then maybe our French friends, Veolia Environment, they hiked the dividend also double digit by 12%. Wolters Kluwer hiked the dividend by 12%. And Wolters Kluwer is also the one that I would like to have. They dropped to €145. It's still below 2% yield, but I start to slowly look at them again.
Mhm.
Then we had Danone with a dividend hike of 2.4%. It's also a large position for me. I was honestly hoping that it would get back to 5 to 6% dividend hikes. But
Yeah,
let's see.
but to be honest, I also own a position, and I think they were quite conservative.
Yes.
Because if I remember correctly, I think they increased free cash flow double digit. I think 11%.
Exactly.
So these past few years have not been easy for the company, but I think the results were quite good, and actually the company, I think it's at the top of the. I think it hasn't been this high in the last at least 5 years. And the results were good in all the divisions, but I think that probably they wanted to keep a little bit of cash just in case. But I think that eventually in the next coming years they will probably have some better dividend hikes.
That's what I would expect as well. Yeah. For me, it's very similar to Unilever of what the company is going through. Okay, then we have Deutsche Telekom that raised the dividend to 90 cents. That's about an 18% hike. Glanbia, favorite of Derek from Ireland.
Well, to be honest,
Yeah.
Glanbia is a company I've started to be interested in a little bit, but I haven't dedicated enough time. But it's a very interesting consumer staple company.
Yeah, I'll share you the deep dive that Derek did. I think
Great.
you'll like it.
Yeah, thanks a lot.
10% increase as well in the dividend to about 39 cents per share. And Up InBev also, they pay now €1 per share from 82 cents last year, 22% increase. Then we have GD Peet's, a coffee company, 4.3% dividend, now at 73 cents per share. And yeah, BASF with a dividend cut of 33%. We knew this already. It's no new news. It's now just written in stone. That's the difference. So I don't own them anymore. Yeah, I mean, what a list of dividend hikes. I mean, my portfolio did so well this week. I was entering all the dividends in my dividend tracker, and I felt like, wow, you can't almost invest against this, right? Like it's, let's say, €50 more here, €70 more there. But if you think about it, to get €50 and you will buy at a 3% yield. Yeah, that's quite some money that you need to put aside. It's €1,500, right, to invest.
Yeah, absolutely. Yeah, February is always a great month for dividend hikes.
Exactly. Which one would be your favorite?
Which one would be my favorite? Well, I'd say, I have to say Iberdrola for sure, because it's of the ones that have hiked, it's my biggest position, and it's a 15% increase. So it's clearly Iberdrola. But then Munich 33%, it's hard to beat.
Exactly. Good. Hey, let's go then to the main topic. And you're a little bit, with your background and all the articles you wrote, you're a little bit Mr. Consumer Staple for me. I remember very vividly the conversation about Coca-Cola we had like in the former episode. So before we start, maybe there were a few questions also related to consumer staples, and Philip had a nice one. And if you think about consumer staples, what will be for you really the main metrics to look at and compare among each other in this sector?
Yeah, that's a very good question. The thing is that consumer staples, I think that probably applies to many other sectors, but there are quite significant differences between subsectors. I mean, if you want to compare a tobacco stock with a cosmetic stock, that it's not going to be really useful, because you are not going to understand why there is a high difference in valuation. I think that one thing that is relevant for consumer staples is in the long term is volume growth, and I think it's important in some cases to check organic volume growth, because many consumer staples have a big exposure to emerging markets. Like, for instance, Unilever that we discussed, it has a bigger exposure to emerging markets than to developed markets. So it's important to consider organic growth, because these past few years haven't been easy for emerging markets, but in the past there have been periods in which this has changed. So another good example is Colgate. Colgate has a very big exposure to emerging markets, and if you see their results, maybe you think it's a company that it's not growing much. But if you see the organic growth, they have a very good organic growth, like maybe 6% a year. So I would firstly focus in that. I think that's one of the most important metrics, because Many people buy consumer staples based on cheap price to earnings ratio or high dividend yield, like for instance, Kraft Heinz. But the problem with some of these companies is that if they don't have a volume growth, then it's very hard for them, because having volume growth is what allows you to reinvest in marketing and so on. And then that allows you again to grow your profits and grow your volume. But if you don't grow your volumes, then you have to cut your expenses in marketing. And then it's a vicious circle. So you have a big problem there. So I think those two things are well, volume growth is the most important one, and then I would focus in margins, both gross margins and operating margins. But you need to know that there are very significant differences in margin between industries. I mean, beauty companies sometimes can have gross margins up to 80%, or spirit companies can have gross margins up to 60%, but food companies generally have margins that are closer to 30%. So when you are analyzing a company, you have to make sure that you are looking in a comparison to a company that it's actually similar to it. You cannot compare PepsiCo with L'Oreal, because the trends in the business are completely different, and the metrics of those business are completely different. So I think that even though they are consumer staples, I would try to differentiate between each of the different subsectors.
Yeah, yeah, and that's also the ones that you mentioned, from volume growth and organic volume growth, right? Because what we've seen over the last years, that it was often just mostly price inflation driving it up, and then suddenly, against the consumer becomes weaker or can't take it anymore, and you can't just hike prices until infinity, right? You will hit the wallets of people. But also other things I would look at, and it depends a bit again on the subsector, because for instance, if you think about Ahold Delhaize, they maybe have a 4% operating margin. But I would definitely look also at the financial statements and the metrics related to that, like debt to equity. I find a very important one in consumer staples, but particularly when you're comparing among each other, because you want those with the strongest balance sheet. And I would also pay attention to inventory and working capital, and how they are managing working capital is actually a sign of good management or not. Yeah, because a lot of money is lost with poor working capital management, and and it's a fine balance, because you can increase your working capital really quickly if you don't pay your vendors on a monthly basis, but maybe on 90 days basis, it blows up quickly the free cash flow. But on the other hand, you need to wonder whether you are creating the supply chain that you want to have, right?
Yeah, absolutely. I completely agree, and yeah, there are some relevant metrics that we have not discussed, but that are important, like return on invested capital. Of course, it's very important, and if you are focusing on the dividend, obviously you need to check what the free cash flow is and the dividend payment. But yeah, I think mostly those things would be the things that you should initially take into consideration.
Yeah. And then before we go to the first company, still, Hussein, someone that's close to us, he asked, like, is it important to actually be customer of a consumer staple company in order to invest in it? So for instance, is it better to invest also in, let's say, a grocery chain that you know locally than investing maybe, even if there's a little bit better metrics, one in a different country that you're actually unfamiliar with? What is your thinking? This is a little bit the question from one up in Wall Street, right? From Peter Lynch, like, buy what you know.
Yeah, if you like the product, buy the stock, right? I mean, I don't think it's necessary to be a customer to buy a company. And actually, I think a lot of people have some bias with this, because I've seen that from time to time, that maybe people don't pay attention to a stock because they don't like the product, or some people say no one around is consuming this product, but that doesn't make much sense when you are dealing with a multinational company. Maybe that company has most of its sales in emerging markets, and it's reasonable that no one in your town in Spain is buying the product, but that doesn't mean that it's an attractive company. So I think, to be honest, that sometimes it's worse to be an actual customer than not, because you can be biased either positively or negatively.
Yeah, I would agree. I would agree. The best is still to have a little bit of distance to the company when you do your initial analysis, so that you avoid falling in love with it. Good,
Yeah.
good. So, hey, this podcast is about the 5 top consumer staples for people's considerations. I think we have a nice list with some big stalwarts in there. And I wanted to ask you, what would be the first company that you would love to talk about out of these 5?
Well, it was actually tough to make the list, because there are quite a few consumer staple stocks that I like or find interesting. But I think clearly the first one that came to mind was Hershey, and it's actually a good choice because it's our friend's Eloy's favorite stock, by the way. And he made a deep dive in the first number of Cartas del Dividendo of Hershey. And I think it's, first of all, it's a very interesting company, because the categories where Hershey is competing have been growing forever, and they have a very interesting characteristic, which is almost no private label competition, which is very nice, and it's something that happens in some consumer staples categories, but of course not on all of them. And the company has had a significant drawdown due to a couple of issues, most notably cocoa pressure on pricing, because cocoa prices have skyrocketed these past few years, because there were some very extreme weather conditions in cocoa producing countries like Ivory Coast, and I think Ghana as well. So of course, being a chocolate company, if cocoa prices hike a lot, that is a drag on your gross margin significantly. But also, Hershey has most of its business in the United States, and in the past maybe 1 year and a half, 2 years, as you know, a lot of consumer staples companies, mostly food and beverage consumer staples companies, have been under pressure in the United States. First of all, because there is a worry by many investors that these new GLP-1 drugs could decrease the consumption of these salty or well, at least not very healthy products. And then also because the inflation that we have had these past few years, the accumulation of that inflation has been a big issue for many consumers worldwide, but until very recently, mostly in the United States, consumers that are in the lower end, especially those below $50,000 a year, have had a big impact, because their salaries have not been able to grow aligned with inflation, and also high interest rates have increased their credit card debts and their mortgage and so on. So there is some concerns here by many investors on whether some of these things can be more structural than cyclical, like whether maybe the taste test from people are changing, and these sweet products or salty products and so on will no longer be consumed in the same volumes as in the past, and also whether cocoa prices are going to be structurally higher than in the past. Okay, so that's where we are right now and why the company has taken a hit.
So I mean, fully agree with all of that, Alberto, and there's something else going on there as well, because this is more from a business foundational point of view, what you're saying. But do you think it was worth paying up 27 to 30 multiple 2 years ago for Hershey?
Well, no, but I think that the issue here is always the same fear and greed cycle.
Exactly.
Because the thing is that when COVID hit in the US specifically, the government gave special payments to a lot of lower income people, the SNAP benefits. So a lot of people had suddenly a lot more of money and they couldn't get out of home. So what did they do? They bought a lot of products, a lot of chocolate, also a lot of spirits, like we will probably mention later. And then these companies skyrocket their profits. They had really high profits, and they were able to hike prices like 10-15%, and that didn't affect their volumes because people have more money and have less time or less things in which they could spend that money. So investors became probably more comfortable on thinking that this was the new normal. So they decided to pay more.
And but that's kind of what I want to go to, because they pay, let's say, a 30 PE for a consumer staple. If we talk about metrics, for me, that's unheard of. When you think about the pack ratio, it would mean that it needs to grow between 20 and 30% annually. It didn't do that. If you now look at the PE ratio, it's 15 or 16. Yeah. So it almost halved the valuation that's been given to the company at the moment. In the meantime, over that time, in October 2021, it earned $7.11. Now it earns around, let's say, $9 to $10. So fundamentally, it has been growing. So what you really see is that there's been a multiple contraction going on over the last 2 years. Of course, cacao prices do influence this and everything. But for me, now it's kind of where Hershey, you would expect it to trade between 15 and 20. If the cacao prices are good and not these shocks to the system, I would expect it to trade around 20, because it's a high quality business. And when there is something like this, you expect it kind of to do like this. So I think it's also important, because many people are so price sensitive, right? They look at the share price as if therefore the company is broken or not. I just look at the EPS growth, and I'm amazed that although they have these cacao prices, although there was this inflation, they're still able to just make proper earnings and have steady earnings growth. But that's what I look at.
Yeah, but I agree with you. But also Hershey is they have a hedge. They have commodity derivative contracts, to protect them from the volatility of cocoa prices, and this hedge is partly why they have been able to keep a high profit this year. Because if you go to the guidance to 2025, because a lot of people are concerned about it, the adjusted earning per share is expected to drop mid-30s. So that will be minus 35%, but that does not include the hedges from cocoa. So it is likely that the actual EPS will be higher, and even
that's good management. When you,
of course,
it's like knowing what your business is, right?
But I think it's a lot of people are concerned because they see a 35% drop, and then if you give if you give the normal multiple you want to assign to that drop, then you get a lower price. But it's interesting that they gave a guidance for free cash flow perspective in CAGNY the other day, past week, and they expected 1.4 billion, and that's interesting because the highest they have gotten is 1.6. So 1.4 is even higher than the free cash flow they made in 2023. So it's very interesting.
If you ask me what the main risk is that I see, is how easy it is nowadays to have your own chocolate brand. Think about Mr. Beast, and they're able to really quickly get shelf space in the shops. So if you ask me what I see as the biggest risk, I think cacao is to Mondelez, Hershey, all of them is the same. Competitiveness, I think the marketing landscape has changed with influencers, specifically Mr. Beast or something like that, that are looking at how can I monetize. And if they have the group of, let's say, the teenagers, where there's also a large part of their consumers that influence the buying, then I think that's something that where I see like, is Hershey really stepping up that game? And is it really is it able to change with this evolving, let's say, landscape here when it comes to advertising landscape? So that's the only thing where I more worry about. All the others, I feel like that's more industry, but that one in particular, I really think like, how will this play out? And how does it position itself there?
Yeah, the thing is that I honestly, I'm a bit skeptical with these influencers because first of all, I think there are few that have actually the capacity to launch a brand that is too big. But then those influencers, this is not their main project. I mean, so they are
come
not,
and go.
They are not focused on this. Maybe they can do something and prove that they can compete somehow, but they are not going to stick in the business, and they are not going to deal with high cocoa prices and so on and so forth. So it's very tough for them. And one of the things that it's interesting from Hershey actually, and from many of these companies, is if you check Hershey's product, most of them were launched in the market like 80 or 100 years ago. So that's in the mind of people, and they also have a distribution that it's unmatched in the US, only matched by Mars. But that's important because even juggernauts like Nestle or Mondelez are almost unable to compete in the US against these companies. So I think that given that for even these bigger companies, it's very, very difficult to enter this market. I think it's really, really complicated for any of these influencers. I think that's noise. And I'm not saying that there couldn't be eventual risk, but I don't think that people is going to want to stick competing on this for several years. I think
it's more like I see. I exactly see what you mean. I think people like Mr. Beast, they are getting very popular. I see to my kids, they want their chocolate, as an example. But to your point, they come and go. And that's the nice thing about Hershey. And I'm very long Hershey. I used last year really the opportunity to buy a lot. Because, why not?
Me too.
Sweet dividends. It's always important, I think, to keep an eye on those risks, because you never know how they play out. And there's one more thing, really, before we go to the next talk. What do you think about Hershey paying for the 5th quarter in a row the same dividend?
To be honest, I think they actually mentioned that they were going to keep the same dividend flat for the year. I think they already mentioned that, and I think Mondelez is going to do the same. Hershey actually has done that in the past quite a few times. So it's not a company with a history of dividend hikes of decades. But I'm not concerned at all, because they actually mentioned that they are going to keep the buybacks, and I think that's intelligent, because the price have been quite depressed. So if they are buying back stocks when cocoa price normalize, they are going to have outside results.
Yeah.
And in their CAGNY presentation, they actually mentioned that they gave adjusted EPS for 2026 depending on where cocoa cost could be. And for instance, they mentioned that if the cost would be at 2023 levels, they would expect to have an EPS of over $12.
Yeah, and that's amazing.
So,
Look, I'm thinking, I'm looking at the same, and what people forget as well, it's and only the last quarter of 2023, it hiked then the dividend by I think 16 or 17%, and the quarter after they hiked it with another 15 or 16%. So it just did a 30 or 40% dividend hike in 2 quarters. Yeah, so I'm with you on this one. I don't lie awake at all from this. And to your point, I think we are seeing excellent management here just at play. Yeah. That's what we're seeing here.
Absolutely,
Awesome.
absolutely.
Good. So that was number 1, Hershey. I'm really, I'm a big fan of it.
And there is one thing also that it's very interesting, just real quick, because I mentioned that in the last newsletter we published, because the price has jumped a little bit in the last month. I think it's around 170, but it was 150 a few weeks ago.
Exactly.
And it was like 2 or 3 months ago that the price jumped to over 200 because there were again speculations that Mondelez was going to take over the stock. So it was quite crazy to me that people would see that Hershey was rejecting a $200 offer for their stock, and then a lot of people were hesitant to buying it 1 month later for 150. You know. So,
yeah, and Mondelez tried already 2 or 3 years ago as well to purchase it, or 4 years ago, but they're not going to do it. I mean, as long as the charity foundation is there, I can't see it happen unless there's like something that breaks up there in the board. But
yeah, Nestle tried a few years ago too. So it's obviously a company very attractive for these companies, but they are not interested in selling, and I'm happy they don't.
Talking about Nestle, shall we talk about that one next then?
Yeah. Okay. So I wanted to choose Nestle for 2 reasons. One, because I know you are not a fan, or at least you have been critical about Nestle a few times. And I made a deep dive of Nestle, I think a year ago or something like that. And to be honest, I think it's an amazing company. And I think they have done some mistakes, but I think that they have had some issues that are completely one-off, or that they couldn't expect, or that are going to change. And it's very interesting to me because a lot of people have been concerned in the past, and I completely understand that, because they have been making share buybacks that exceeded when you addition the dividend, the free cash flow generated in the year. So they have been increasing their debt level with the buybacks. And I think that wasn't an intelligent move by the previous CEO. But one thing that I found out, and they shared, is that their free cash flow level has been depressed these past few years. First of all, because they have made significant capex investment, mostly for increased capacity in coffee and pet foods. So they usually have had like 4% of capex related to sales, and these past few years they have been close to 6%. And they also have had a high level of working capital, because they had a high level of inventories as a consequence of supply chain disruptions and so on. So if you normalize those things, that could be something similar to 3.54 thousand million Swiss francs. And in 2023, they had a free cash flow of over 10,000. So I think that the company could very well, in maybe 2-3 years, depending on what the new management decide, they could be doing quite easily at least 13,000 Swiss francs of free cash flow, maybe even more. And I think that's close to 6-7 free cash flow yield. So I think the company has been quite attractive in the last month. Unfortunately, it's up like 20%. But they have very, very interesting attributes. They are exposed to very, very attractive categories, pet food, coffee, some very interesting nutrition categories, vitamins, and so on. But they have been hit with high cocoa prices, high sugar prices, high coffee prices, inflation accumulated by some customers. The previous CEO created the vitamins category by buying many companies, and they had some initial trouble unifying all those companies and so on. So I think also the previous CEO wanted to grow inorganically mostly. And I think that that's not something that many people in the company like, because it was actually the first CEO from outside of Nestle. The CEO had always been an insider. And I think the new CEO, I like a lot what I've read from him. I think he's really focused on what matters for these companies, in investing more in marketing and in the brands, and focusing on big opportunities. And I think the following years from Nestle are going to be quite good. He has cancelled the stock buybacks until that level is reduced to a slight lower level. And also, what I like from Nestle, because what I like most from consumer staple companies is longevity. And I think Nestle has something really important. That's also their big stake in L'Oreal. They have 20% stake in L'Oreal. And some investors, I think it was Tom Russo, mentioned sometimes that Nestle used to have a debt level that was more or less the stake they had in L'Oreal. So if they would sell the stake, they would be debt free. This has changed recently because the L'Oreal stake has dropped a bit, and also the stock hasn't done very good, and because they have taken a little bit more of debt. But I think they are on the right track. I think debt level is going to reduce significantly in the next 1 or 2 years, and I think free cash flow is also going to increase quite much.
Yeah, it's interesting when listening to you, Alberto, because it's clear that the CEO is screwing up this company he was trying to prop up the share price via buybacks, inorganic growth, and I think he failed on that. So it's really good to hear that there's a new CEO in town that, like probably what we see in Danone and Unilever, are having the hard task ahead of them to get back to organic growth. The Swiss franc plays also, of course, a big role into this topic. I mean, I because of how the former CEO was managing the business, I became really skeptical on it. The trend just looked really bad. If you look at how quickly he was deteriorating the balance sheet, but it's nice to hear you talking, because it means like, okay, there's a way out. I do believe that, you know, having Nestle trading at 75 just a few weeks ago was I mean, probably a little bit too far to the downside for where it could be. But yeah, it's a tough one. I also agree with you with the longevity, but it's also the example of a slow compounder, right? And this may be where I want to ask, like, do you see any secular tailwind, secular growth opportunity for this company? Or is this too much to ask from a company of that size? Is it just more about the stability and the inflation-adjusted growth, let's say?
Well, let's see. The thing is that Nestle, if you take organic sales in the last decade, I think prior to the last 1 year or two, they had grown a little bit up of 4%.
Mhm.
And their previous guidance, it was +4, +6.
Yeah.
But I think that for a company like Nestle, if it can grow at 4 or 5%, that's pretty fine because
Exactly.
because you have a 4 or 5%. Many people think that's low, but if you have that and then you have some cost savings, improvement on efficiency, and so on, maybe you can get another half or 1 point on operating margin. Then you have some buybacks, and maybe you get +1, +2%, and you have a 3.5% dividend. So, and you can obviously reinvest that dividend. So if you have a 4 or 5% sales growth, it doesn't take too much for you to have a double-digit return in your investment. So I think that's actually the thesis for Nestle and for many consumer staples. And I don't think they are going to do nothing really, really different. But some of their categories they are now working on, they have a good structural growth, like pet food and so on, coffee, and all the nutrition, because they have Nestle has a very, very big research and development department. I think if you compare research and development expenses in Nestle, for instance, with a company like Kraft Heinz, it's a multiple times higher.
Yeah.
And they have a lot of interesting stuff that you wouldn't believe that the company is doing. For instance, I was reading a few days ago that they were doing a treatment with prebiotics, probiotics, and so on, with women that wanted to have kids but were unable to, and they kept the treatment, I think, in Brazil, with a significant amount of women, I think maybe 1,000, and they through this treatment improved significantly the possibilities of them having children, mostly for overweight persons. But then they kept the treatment subsequently, and they improved the way these women could give food to their kids, and improve how these kids were raised subsequently. So I think Nestle is a very, very interesting company, and I think they have always been quite innovative company, and as some like to say, a company that had always been willing to suffer, because they developed Nespresso, and they had like 10 years losing money with Nespresso, and I'm sure a lot of CEOs would not have been fine with that. And they really are. So I think when you think of longevity, I'm quite confident that Nestle is a company that it's going to be compounding for many years, slow compounding, but I say if you can really go back to that 4 or 5% sales growth, you don't need much more to get to a 10% return, which is what you are going to get at best in the market.
Yeah. No, good one. Hey, it's number one in my Noble 30 index, as you No, I'm not a big fan of it. I don't have that feeling for it that you have for it, but that makes this investing world
Yeah,
so nice.
of course.
And yeah, I'm vouching for it because it is the dividend growth company in Europe, and we need to really give them some love for that. Good.
Mhm.
Talking about love, what do you think then about the next one? Reckitt Benckiser, of
Mm.
course, known for all their love products here.
Yeah, absolutely. Well, Reckitt is a very interesting company. I think it's a company that many investors have mostly forgotten about, even though I think it's one of the most interesting consumer staples in Europe, and historically it's a consumer staple that has been one of the best performers. If you take a long-term view, Reckitt has done better than Unilever or Procter and Gamble, for instance. But the company has had some issues
Yeah,
this,
but for that you need to take a very long view, right?
yeah, like
Yeah,
20 years or
exactly,
something like that. Yeah,
exactly.
yeah, yeah, yeah. Because this past few years they have had
Mm.
some trouble, but the stock dropped quite significantly like a year ago or something like that, because they had an issue with a claim in court, for an issue with premature infants for some of their formula
Mm.
that supposedly was creating an issue as some sort of, well, it's called NEC. To be honest, I'm not really sure what it stands for. It's like necrotizing something, but
Mm.
it was an issue that supposedly caused death in some premature infants that had been taking that infant formula. So the stock has dropped quite significantly as a consequence of that. And I think a lot of investors are a bit concerned when there is some claims in this regard, because a lot of people have Bayer in their minds, and they have
Oh,
3M in their minds, and so
yeah.
on. So when you have one of these things, it's always a bit concerning. But in this particular case, I think it's the company has had public statements by the FDA, the American administration, and some other administrations, even the Pediatrics Association, stating that they do not share that, and that the products by the company are safe and fine. And actually, I think they a few months ago they had a court resolution that they backed their statement, and the stock has gone up like 20%, so it was quite depressed. But I think it's still quite reasonably priced, because they are generating, I think, close to 2.5 billion of free cash flow, and they have a 50% payout. So they are paying half of that, and then they are buying back the rest. So they have like a billion buybacks. They have a reasonable amount of debt, and they have a free cash flow yield of near 7%.
Nice.
And it's a company that I think a lot of investors don't like a lot, but if you check it, it has amazing margins. It's extremely profitable. It has like 60+% gross margin. It has leading brands. So they have had some trouble with infant formula, and they bought a company that it's Mead Johnson Nutrition, that it's been a mess, but I think that's mostly solved. So I really think that it is a company that it's starting again to grow organically, like many consumer
Yeah.
staples, and it has a reasonable level of debt, I think around 2 times, so nothing worrying. And they are planning to to sell some low-growing stocks. Some low growth brands, like 30% of those brands, and the remaining 70% of the business that they have grown organic sales in the last 5 years by 7% annually.
No.
So I think it's actually a very interesting company. And by the way, there is some professional analyst that made estimations with regards to the claims that could be requested to the company, and they estimated it in between 1 and 2 billion. So I understand that maybe some investors are concerned, but this company is generating almost 2.5 billion a year, and it only pays half. So even if they would have to pay 2 billion, that's just the buybacks for 2 years.
Yes.
So I don't see that as extremely concerning. And this company trades way cheaper than some comparable companies that I think are, in some cases, less profitable to it.
Yeah, no, it's a nice company. I mean, I don't own it, full disclosure, because I historically have had always many consumer staples in my portfolio. It's a nice one, and I mean, half jokingly, it is a company where I know their products very well, and I like them. So, not
you mean the cleaning products, right?
Yeah. Well, you need to wipe it off, right? No, it's another nice European company, right? Well, yeah, England is still Europe, I would say. So, and compared to Nestle, I think what makes it more interesting here for many investors is the dividend tax. Because if you're living in Poland, and I don't know if you have the same in Spain, but in Poland you have those tax advantages retirement accounts. So you don't pay any dividend tax then on those. While at Nestle, you're still with those 35%, right? There.
Yeah, we don't have tax-free accounts here, but still taxation on the Swiss stocks is 35%, and on the UK stocks it ranges from 19 to like 25, 26, depending on your income. So that's an advantage there for UK stocks always.
Yeah. Hey, we have two more stocks to go and a ton of questions still. I'm watching the time. Goes really it goes really good. I think our listeners will be happy this week with an extended version. But hey, I don't need to go anywhere, Alberto. I'll need to buy that later.
Okay. Great.
Next one. Let's go a little bit now into the sin category. Although people would argue that Nestle is also a sin stock. How about
Hershey too?
Yeah, Hershey too. I mean, does there exist any stock that doesn't have some sort of sin, right? That's how I think about it.
Absolutely.
But I like this. I like their products probably more than the stock, and that's Diageo. Shall we talk a bit about them?
Yeah. Well, Diageo, it's very interesting case. I think you could find some similarities to Hershey, actually, because all the spirit sector has gone down quite a bit, but it's similar to all the drink sector generally, because also companies like PepsiCo has derated also, and food companies, as we previously discussed. And this is a bit a similar trend with some particularities, because as with chocolate companies, Diageo had great years during COVID. Similarly, people couldn't go out of home, so they didn't have much thing to do with their money and their time. So people bought more alcohol and they consumed at home. So sales spiked, and many investors probably thought that would not be temporary but permanent. And so some of these companies traded at 3 times PE. And then we have had some sort of hangover afterwards. And especially it's important to notice that many of these companies, to see what's going on, you need to focus on the United States, because for many of these companies, US is the biggest market, and Diageo it's no exception. So a lot of consumers in the US are stretched, and many of them had probably a stock of booze at home. And also there is a particularity in the US with spirits companies or alcohol companies, that there is a 3-tier system by law, so that producers and distributors and wholesalers have to be independent. So Diageo cannot distribute the products or cannot sell them to third parties. And this led to a vicious circle, because when consumers were requesting more booze in these previous years, wholesalers were buying more from the distributors, and then distributors were buying more from producers who had to produce even more. So then there has been a lot of excess inventory, and this hangover has been going on for quite a while, like the last 1.5 years and so on. But as with other food and beverage companies, some investors in the US are also concerned about whether GLP drugs will lead to a lower consumption of alcohol, or whether new generations are drinking less, or whether cannabis is going to overtake alcohol and people are going to drink less, and so on. So basically the company has derated quite significantly, and also more recently the risk of tariffs by Trump, which obviously can have an impact, because these spirits companies have the particularity that some of their products can only be manufactured in certain places, like cognac in France, or Scottish whiskey in Scotland, or tequila in Mexico, and so on. So I think this is similar to what we discussed previously. For me, it's again the fear and greed cycle. It was all greed when things were going well and sales were skyrocketing, and then when there is a normalization, there is always a lot of concerns, and the multiple is lower, and people are reluctant to buy the stock. So I pretty much like spirits companies, not only Diageo, and I have been buying some of them of lately, and I think it's a good time to include them if you don't have them, or to buy some more of the stock.
Yeah, I don't have them. I struggle a little bit with Diageo, with the free cash flow and everything, and what they've been showing, and how to say it. I think you're spot on with, let's say, all the sales being brought forward. I mean, people. I mean, I think I know from private life that even some people start to struggle with alcohol, right, during COVID, because you're sitting at home. Where do you get your joy from, right? So people start to take on behaviors that are just not good for people. I just struggle here again a little bit. Like, I think it is now finally a little bit trading at prices where it deserves to trade after a few years of indeed very, very high prices. But I'm missing a little bit what I look for is always is a decent yield, but also with proper growth prospects. And if you look at the whole stock universe, there are usually only 4 or 5 at a certain moment in time that I'm interested in. And for me, Diageo actually looks worse than what it looked like 4 years ago or 3 years ago, if you look at just the financial metrics. So then I'm wondering, okay, I get it at a lower multiple, but actually now now it's maybe not even so interesting anymore then. Yeah, so I really struggle with Diageo, because I agree with all the assessment that you do, but then to think about buying into it, and I don't need a liquor stock in my portfolio, right? I have the joy of missing out. So there's still for me too many flags, which kind of keeps me not giving this warm feeling about it. And sometimes hard to address, but it's mostly influenced by the three financial statements when I every time look into them.
Yeah, I understand what you mentioned, and obviously the financial statements right now look worse than a few years back. But that's to be expected, because those figures were probably not really reasonable. But also you have to take into consideration that there are aspects that have had some impact in the company's free cash flow. They have increased capacity quite much these past few years, so capex investment have been quite high and should go down. And then there are other aspects that are relevant, that agave prices, which is the main raw material for tequila, also skyrocketed, and they have gone down very, very significantly. So that will add up for the gross margin for the company. So I think going forward, the figure should be quite better. Not this year. I think this is still going to be a transition year, but I think it's going to be going forward again a steady grower, and I think it's also going to be a company that can grow at maybe 5-6% sales. I think that's at least what I expect, and that's going to be able to somehow improve slightly its margins and buy back some stock. So the figures are a little bit.
Sorry for interrupting, Alberto, because I agree with all what you say, but also, what do you think about management? Because if you look at management and its guidance, I like, for instance, CEOs that are using the UPOT method, under promise, over deliver. And I see management all the time struggling. At a certain moment, I just wonder, like, stop giving guidance, stop fooling around. Yeah, I have a feeling like when you have those companies, when you read the earnings, the summary, you think like, wow, they had a rocket year, like best in history, and then you look at the details, you think like, wow, are they fooling me here?
Yeah, I completely agree. But actually, just recently, Diageo stopped giving guidance.
And finally,
they stopped doing it in the short term, because they had the previous guide that was +6, +8. And they reduced it. I think they reduced it to +5, +7, and I think they canceled it altogether recently, due to uncertainty and also situation with tariffs and so on. So I think that's the case, and I agree with you. I like under promise and over deliver. And for instance, I think that's something that the new CEO in Nestle is doing. I think that he seems to be, at least for me, a very intelligent person, because Nestle had a previous guidance of +4, between 4 and 6 organic sales growth, and he lowered it to +4. But I mean, you could achieve the same, because I mean, if you say +4, you can still get 6, but you are lowering the expectations, So I think they kind of did the same thing a little bit here, and I think spirits is a very interesting category still, and that has, unlike many other categories in consumer staples, they have an easier possibility of premiumization. Because if you are selling dishwasher products, it's much tougher to have some premium products than if you are selling like cognac or
Yeah.
some aged products that it's easier to sell at a price that it's higher.
Yeah. No, nice one. Nice one. I mean, Diageo will probably for me always be a difficult stock to fully grasp. But and you own your own shares, right, in Diageo?
Yeah.
Yeah.
I own shares in Diageo and some other spirit companies as well, like Pernod Ricard and Brown-Forman and Campari. I own
Yeah.
those four, and they
Okay.
all are quite different, and they all have some particularities.
Yeah.
But I think they actually are all at attractive prices
Yeah.
right now.
Yeah, and I would say the dividend is quite safe, and you get, what is it, 3.7% yield now?
Yeah, I think
So
something like that.
that's over the last decade. If you compare, it's a very, very decent yield, right? Very good yield.
Yeah.
Good. Hey, then the fifth stock, definitely last but not the least, and I mean, it's British American Tobacco, and we got a few questions actually, because Inversor, the incognito, was asking, what is your favorite tobacco company to invest in at this moment? And is this British American Tobacco?
Well, to be honest, I struggled to choose the fifth company, and I chose it because I saw the questions, and people always love to discuss tobacco stocks, I guess, because yield is high and it's been growing almost forever. So most of the investors love it. Well, if you ask me about my favorite tobacco company to invest right now, I think I would probably say British American Tobacco. But I may change between them and Imperial Brands, which is something that probably would surprise many people. But I'd say that I would choose either one of the English companies. And I think we have actually another question regarding British American Tobacco, but I don't know if you want me to discuss that question now or maybe later.
No, let's do it while you're talking. We
Okay.
can ask the question about it. Yeah.
Okay, so British American Tobacco is a very interesting company, and it's optically extremely cheap if you only consider consumer staple companies. But if you compare it with the spectrum of tobacco companies, it's not extremely cheap if you exclude Philip Morris, which is trading at a premium valuation, and in my opinion, that's justified. But the thing with British American Tobacco is that it's actually at least until very, very recently, it's the only global company that it's operating in all the countries. And the company has a traditional combustible business, which is what drives most of the profits. And that business is significantly struggling in the United States. And the United States is the source of the company's, the biggest source of the company's profits. So a lot of people are concerned that there is a higher drop in volumes in the US for British American Tobacco. And some of that drop in volume is structural. It always there has always been a reduction in volumes in tobacco, and there always will. But some of it, there are arguments to defend whether it's structural or not. I think there are clearly macroeconomic issues that it's quite similar to what we discussed for other consumer staple companies, that consumers are incredibly stretched. Nestle actually mentioned that when the US government retired those SNAP benefits for lower income at the end of 2023, many families lost half of their income. So it's crazy, because if you take half of your income, all of the sudden, of course, you are going to reduce your consumption of many
Exactly.
things.
Yeah.
Or you are going to trade off brands and so on and so forth. So that's one thing. But then there is a second thing, because that's something in my view that's temporary. But there is a second thing that it's quite concerning in my view, which is proliferation of illicit products. And I think that's not something that it's going on only in the US, here in Europe as well. A lot of vaping, disposable vaping products sourcing from China has been flooding the market in this past 1 year and a half and so on. And they have completely taken over the vaping category. I think they now make around 70% of the vaping category. And this is, in my view, one of the biggest concerns concerning regarding tobacco stocks in many years, because this raises questions about two of the things that are and have always been more relevant to tobacco, which is barriers to entry and loyalty to brands. Traditional tobacco, there were very high barriers to entry due to regulation, and there were people have had historically a very high level of loyalty for the brand. A lot of people started smoking a certain brand and they never changed in their life. So right now you have these disposable products, and if you think about it, it's quite interesting, because you could argue that these disposable products are actually the new generation product, that it's more similar to a cigarette, because you don't have to charge it, you don't have to pour a liquid in it. I mean, you just use it and you throw it away, just like a cigarette. So if these products are taking share from traditional tobacco, in my view, they are a threat not only to vaping or to traditional tobacco, but also to other forms of new categories of nicotine, like heated tobacco and so on. So right now, the regulators in many countries are starting to take measures, and in many states and in some countries in the EU, they are trying to forbid these products. But I think we will see how that works out, because prohibition is not always easy, and the outcomes are not always what you expect to be. And they have that first issue there, and they have done some other troubles as well, because there are two more categories of new generations of nicotine. They have nicotine pouches, and it's interesting because they have the best nicotine pouch product outside of the US, but they are not still allowed to sell that product there, because you need to request authorizations to the FDA. And while they do that, Philip Morris is taking a huge amount of share with the product that it's seen. And in many consumer products, first mover advantage is quite important. So we will see if eventually British American Tobacco is able to commercialize this product, and if it's able to have a
they'll
bigger
have to
market.
Alberto, they'll have to, because this was also a question, right? You addressed it straight away from Maestro Inversor, but if and I mean, this is not so much British American Tobacco, this America. If America allow for it, for this to happen, if they don't really trace all this down and shut it down, it means that there's not a lot of incentive for companies to innovate, to make new products here. It is pretty much like pharma. So the American government, in my opinion, they really need to do this, because otherwise they are taking incentives away in this space. Now the question is tobacco, a good thing for society or not, right? But I really feel like if the American government and the European government doesn't do it, it's not protecting a free market. So they have to do something here.
I agree completely. The thing is that forbidding a product historically has not been easy, because what has happened is that the black market has arisen,
Yeah.
and when this happened with spirits in the US
Yeah.
in the 20s of the past century, but it happened during COVID in South Africa. I think it was South Africa that they banned tobacco, and
Yeah.
they had a huge problem, and they had a huge rise of black
But
market
it's not
and
about
crime.
it's not about, let's say, blocking the entire market. What it means is, for me, like, fair rules. Yeah, that everyone plays according to the same rules
Mhm.
in the game here. Yeah. And
Yeah,
if
of
there is
course.
someone that has a patent, well, you need to adhere that. It's very simple. Yeah.
Mhm. I agree. I agree that obviously they are doing things and they are taking measures, but it's interesting because this started with disposable vaping, but right now they are also having a lot of unapproved nicotine pouches products
Yeah.
that are flooding the US market. And they are even having a lot of illegal cigarettes flooding the market, because, I mean, if you can get away with one illegal product, you can
Yeah.
do the same thing with many others.
Exactly.
So, I think I still think British American Tobacco is an attractive stock, to be honest,
Yeah.
and mostly because I have a slight different view to um, many investors, and I think that combustibles are going to be a profitable business for these companies for quite many years than what
I
many believe.
I think the same. I think I mean, whatever people say, the data tells us all the time something else. Yeah,
Mhm,
so I'm with you. I really like British American Tobacco. I don't own it.
mhm,
My wife, I have this deal with my wife that I don't buy any tobacco stocks.
mhm,
That's the only thing that she doesn't want me. For the rest, I've got free space in my or in our portfolio. And I think
mhm.
when you're investing together, you need to respect that, right? Everyone has
Yeah, of
their
course.
demands, so that's why not. But otherwise, I would have been. Otherwise, I'm sure that British American Tobacco would have been my top 5 dividend payers. I'm pretty sure of that.
Mhm. Yeah, so I think it's still an interesting company, but I understand that the valuation is kind of depressed because the company has challenge, and I think it's normal that many investors are concerned about it. Although I think they will eventually do fine, and they have had some issues these past few years, but 2026 to 2026, I think it's going to be once again a quite good year for them,
Yeah.
and it should be the start of several better years.
They're really getting the depth in control after the acquisition of American Reynolds. So, and to your point, next year or the year even later, I think we could expect, for instance, much more buybacks as well, right? I think that was also one of the guidance that we were giving.
Mhm. Yeah, absolutely, and I think that's key for these companies because a lot of institutional investors don't want to own the companies or
Yeah.
cannot own the companies. So buybacks by them at depressed valuations are actually very helpful, and that's why Imperial Brands actually has done extremely well because it's
Hmm.
been trading at 13 or 15 free cash flow yields, and they have been only paying a dividend on half of that. So they have been buying back like 6, 7, 8% of the shares outstanding a year. And they have been the best performing tobacco stock like the last 5 years in compounded annual growth rate.
Exactly. Exactly. Hey, I mean, Alberto, thank you for walking through these 5 stocks. I knew it already, and you proved it again today. You're a book of knowledge. I mean, your in-depth knowledge about this is really like second to none.
Thanks a lot.
Really
Thanks a
nice.
lot. It's really fun
Nice.
to always speak about this stuff.
Exactly, exactly. And we're not done yet.
Yeah,
So hold on, because we have a really nice bridge actually from the first listener here, and that's Wolf of Vught. he has been asking actually, because when we were just touching on buybacks, he's asking like many consumer staples have high payout ratios and low growth. Yeah, some even have share buybacks and dividends just not covered by free cash flow. And he's wondering, should we not just avoid them? And how can they still grow their revenue and free cash flow for the next years without increasing prices? I think the second question we've addressed already throughout the other companies. But how about this share buybacks and dividends not covered by free cash flow? What is your thinking in general there?
Well, I think that most of the time when this happens, it's based on specific circumstances. I think that probably with some exceptions, many of these companies in some years can have buybacks and dividends that are not covered by free cash flow because they have some reasons why free cash flow may be depressed in a certain period of time. I generally think that in those cases, unless they would consider the stock to be really, really, really cheap, I think it would be more reasonable to stop buybacks. But I don't think that the fact that they don't is always or necessarily a concern. I think what you need to check is how long has that been going on, and also whether if you normalize the free cash flow, that free cash flow is higher and it's expected to be higher. Because it's for instance, in many cases, a company can have a certain project and do a big capex investment, and maybe that capex investment is higher than all the free cash flow generated in the year. But
that's why we give Texas Instruments now, right?
Yeah, for instance, Texas Instruments is a very good example. But if the company, for instance, Texas Instruments, what they say is this capex is discretionary. In the future, we can decide to invest a lot less in capex than what we have done right now, and we think that this is going to give us a bigger competitive advantage in price in the future. So we are going to keep the dividend, even though free cash flow because of this investment is not going to be covered. Some people would say that it would be more reasonable for the company to cut the dividend, and I think there is a good argument to say that. But if the company is operating in a very stable sector, I think as long as the debt levels are low or reasonable, I think that's not an issue. So there is a response that fits all cases. You should check case by case. If you see that debt is continuously increasing and that clearly the company is not generating enough free cash flow, then surely you would need to avoid them. But there are cases in which a company has a lower level of free cash flow for certain reasons, like in many cases a higher capex cycle, and I think that in those cases it's not necessarily an issue to have buybacks and dividends not covered by the free cash flow.
In my opinion, in those, and what I like about this question is that definitely it is something that I would call like not a red flag, but an orange flag, which means like, if you see that, you should do some more research in this area to understand what it really is about. For me, in those situations, I would only allow it when the stock is clearly undervalued, like clearly, yeah. Otherwise, I would say just stop the buyback. Why would you do a buyback at overvalued prices and then even when it's not covered? It's just not, for me, it's then not really adding shareholder value. Then you're probably just trying to prop up the share price for the bonus of the CEO. Yeah. Good one. So then the next one, and this is from David Maret. He was asking also on buybacks, and that's why I combined them. So When would the buyback program stop if the company keeps having great financial tailwind and realistic PE ratio? At some point, the company will run out of shares if they, for example, buy back 10% annually for 10 years. Well, actually, if you do 10% annually, you never hit zero, first of all. So, but yeah, when how do you, it's a very interesting question, one that we never had before.
Well, it's actually quite interesting because a few years ago, like maybe 1 year ago or something like that, or 2 years ago, some of the tobacco companies like Imperial Brands and British American Tobacco were trading way lower than they are now, like maybe 30%, 40% lower. And if they would have canceled the dividend, those two companies could have bought back the whole of the company shares at those prices in less than 10 years.
Yeah, exactly.
So that's interesting. They could have taken the company private.
Exactly.
Yeah, that never happens because obviously unless the investors think that suddenly after the 10th year the company is not going to be able to generate any free cash flow. Obviously, the market sees what's going on and the price hikes because each investor is less willing to sell you their stocks at a lower price. So it's very hard for this to happen. But there are some interesting so-called cannibals in the US market that have been buying back shares like AutoZone, for instance, is a very interesting company that I think they have bought back a massive number of shares in the last maybe 20 or 3 years. I don't know if they have bought back like something like 70 or 80% of their stock outstanding, but really a lot. But the thing is that, as you say, obviously 10% of a smaller amount each year is a lower percentage, and you never end up buying all the stock because there are shareholders that are not going to give them
they will never get my will never get my Shell shares. I would just be then vouching for CEO.
So theoretically it could happen, but in practice it's unlikely.
Hey, next question is from Bovida Inversion. First of all, he's very much looking forward to this conversation. But his question is for the people that are starting with investing, high initial yield or sustained dividend growth. What should be the choice, I guess, and what are the factors to look into and to understand if the dividend is safe? So maybe that's the question very quickly. High initial yield or sustained dividend growth? What will you go for? Dividend growth or high yield?
Well, between the two, I would go to sustain dividend growth.
And then the question is like if you then think about it, like sustained dividend growth suggests that you understand that you have a view on what dividend safety is, right? So how do you define a safe dividend?
Well, first of all, I think that depends a lot on the kind of company you have. Because in some cases or in many cases through the time, I have become less concerned about dividend of companies increasing each year. There are companies that, due to their characteristics or the sector they operate in, have an easier path to a dividend growth. A continuous dividend growth, and that's interesting because if you simply check the dividend aristocrat list, you can see that there is that list is disproportionately formed by consumer staples companies or companies that have some similarities with consumer staples companies, like some consumer discretionary companies, but that are like McDonald's, or some basic material companies, but that are like gas supplying companies that have long-term contracts and so on, or some healthcare companies that have some consumer attributes. So if you have a company like Coca-Cola, it's easy to expect that dividend to go up almost every year or every year. But if you have a company like Shell that you already mentioned, well, it's reasonable to understand that there could be extreme times in which the best thing the company can do is to cut the dividend. And you shouldn't be upset if the company is cutting the dividend at a certain moment. Actually, you should be glad they are, because when Shell cut the dividend and Exxon kept growing it, I was shareholder of both, but I was quite worried because Exxon was paying that dividend with debt, and the debt pile was growing. And eventually, they proved that they knew what they were doing, because cycle changed and they were able to reduce debt quite radically. But I always thought that Shell's approach was better. But if Shell would have been a US company, probably they would have kept the dividend growing with more debt.
No, I don't think so. Maybe Shell would have never been in that problem in the first place. But because, for instance, the balance sheet of ExxonMobil has always been stronger. It had a AAA balance sheet. Shell didn't have. Yeah. And so, in my opinion, ExxonMobil was managing it better throughout the cycle, I would say. Shell not. And that's why they got into trouble and they had to cut the dividends. And ExxonMobil was much more set up for protecting the dividend going into the cycle. And here, even if I would have one critical note at Shell at this moment in time, it's still they should pay down more debt. If you compare all the oil majors, then Chevron and ExxonMobil have really an excellent balance sheet. Shell not. I mean, Shell is much better than it was 2 years ago, but it is still not as good as the one from ExxonMobil, as an example.
Yeah, but that's the thing, that a company that like Exxon, they take the dividend really, really seriously. If you see what the CEO says, well, they consider that the dividend is basic because they have a large amount of shareholders that are expecting them to pay and to increase that dividend. So for them, that dividend is somehow some sort of an obligation.
Sacred. You know? Yeah, exactly.
Yeah, and that's a different approach to Europe.
Yeah.
So what I'd say, and I agree with you, that probably if Shell was a US company, they would have managed the company differently also in the past.
Yeah. And
probably they would have had a better balance sheet, but then they would probably have not cut the dividend, because it's like a different approach with regards to dividend in that case. I think it's quite different.
Yes, and sorry, and no at the same time, because I believe Shell until that time didn't cut the dividend since the Second World War. So that was after more than 70 years that they cut the dividends, right? So I really think like management just screwed up there. It was Peter Voser at the time who was a CFO. But yeah, I studied these companies too much. I don't want to go down the rabbit hole. But I think at least what was needed at the time was that Shell did this giant reset, with the dividend, because they would have been deteriorating the balance sheet entirely after the British gas thing. So it was the right thing to do. I'm with you that some companies will have to cut the dividend from time to time, and that's probably good for that company. For me, I don't really want them in our portfolio because I'm more even an income investor, and I want to minimize the amount of dividend cuts in my portfolio when our portfolios are under stress. So I can have one or two, like LVMH, where I could expect something like they did in COVID. And because there will always be a few that we won't expect it from, but are in the blast zone or something like that. So that's why I'm very, very keen on dividend safety and try to avoid actually companies in my portfolio like that, because it's just like, I just want to protect my income.
I understand what you mean, but again, I think it's a bit of case by case, because LVMH, as you mentioned, Louis Vuitton, is a good example because they, like many other French companies, they had the guidelines from the government.
Exactly.
So L'Oreal froze the dividend after
Yeah.
many years, and Pernod Ricard cut the dividend as well. And those companies would not have done that if they would have been.
And that's why they get a pass.
Company.
That's why they get a pass at that moment in time. Yeah, exactly. Otherwise, I wouldn't have probably even invested in them now. Yeah, interesting. Okay, next question. GVDK, he's asking, how do we handle currency costs? For example, if you buy an American stock with euros, you get conversion fee. Convert per buy or convert a lump sum for multiple buys?
I convert per buy actually, but I have an account. I think you do too in Interactive Brokers.
Yeah.
So I have an account in, for instance, in US dollars.
Yeah.
So of course all the dividends that I receive from US companies are already in dollars, and I do not have a conversion fee there. But then again, if I have money, I convert it to, and if I have euros, for instance, and I want to buy a stock in a US company, I convert it to dollars, and I don't wait to have a big amount to make a lump sum for making buys.
I also don't want to do it because I'm dollar cost averaging, and I also want a dollar cost average in the currency exchange. I don't want to play the currency exchange, for instance, putting things in dollars and suddenly it drops and you need becomes more expensive, and then you get less shares for that. Yeah, good one. We were just talking a bit about oil, and Gordon is asking, shouldn't big oil companies start looking at buying up profitable but beaten down trusts like Greencoat, UK Wind, or the Renewable Group? So to slowly make the transition. And that's an interesting question. I never really thought about it because I don't really like that Shell and such are investing so heavily were investing so heavily in renewables themselves. I always say to Derek as well, like, if they just make sure they have a healthy balance sheet, then they can buy their way out of it. Yeah, the moment that I said some companies start to prove that there's a new market with proper cash flow, they can just buy it. And actually, when you think about Greencoat UK Wind, now a 9% yield, company is expecting to grow at around inflation or 1% above inflation. It will never be a high grower, but there is something to this one. It's an interesting one because buying a company or a trust like Greencoat UK Wind with a 9% yield almost, relatively stable. Yeah, it's a thought I never considered. A very interesting one. Yeah. Good. Meriadoc Beard Gamo is saying good afternoon to you, and he's asking, like, if the European Union normalizes taxes on European shares, which we spoke a little bit about before, do you think that many people invest more in quality European shares instead of investing in US shares? And by the way, shout out, memories of a subscriber to the best dividend newsletter that existed in Spain.
Yeah, he's one of our subscribers. Actually, some of the comments are from subscribers, which I say hello to them and thanks. Well, I think it's likely. I think we spoke about this, but I think it was in private prior to recording the podcast. That of course, a lot of individual investors have concerns investing abroad because withholding taxes are higher in some cases that they have in their own countries. They have to deal with recovering double taxation and sometimes, or in many cases, excess with regards to the double tax treaty. So I think that hopefully with that fast new directive that hopefully will come into force by the end of the decade, it will lead to more investors choosing European stocks instead of US shares.
Yeah. I think so. Yeah, good. And then Another Spanish guy that I met face to face on our dividend day, Rafa. He was with us in Utrecht in the Netherlands. Really nice guy.
Yeah.
And he's very happy that you're back on the show. He is interesting to hear. What company surprised you the most from the European earnings? Let's say in the last few weeks, positive or negative?
Well, actually, I have checked quite a lot of earnings. I would say a bit differently. I haven't seen a lot of big surprises, but for me, I would say that some of the surprises are the market reaction to things that, to me, were at least somehow expected. For instance, at the same day, Unilever, Nestle, and British American Tobacco published their quarterly earnings, and Unilever and British American Tobacco were down high single digits, while Nestle was up high single digits. And I think Nestle did absolutely nothing different to what they had guided and promised. So probably the market just was hoping for something worse. And Unilever posted, in my view, quite good results, even though they guided for a little bit of a slowdown of the start of the year. But I don't think that was deserving of a high single digit drop. In British American Tobacco, that's also interesting because they have had a settlement for a long litigation that it's 25 years old in Canada, and that was known for a while, and they booked a provision due to this of 6 billion pounds, but this was known already, and the company lost 6 billion of market share. So. Yeah. To me, more than surprises on earnings, which I haven't seen something very surprising, to be honest, is I'm still surprised sometimes to the reaction to earnings.
Yeah, for me, it's the insurance companies. For me, overall, like the Allianz, Munich Re, and then Group. I mean, I didn't expect so much power behind these companies. It blew me a little bit away in a positive way. I mean, I knew they were doing well, but this was much better than I would have never guessed it. Never. Yeah. And yeah, okay, we need to have this question really from Eloy, your friend, buddy, co-author of all those newsletters, all those evenings that you were together, all the highlights, probably the lowlights, and he is having two questions for you. First of all, which stock are you buying with more conviction right now? That's maybe the first one.
Well, I have to say that what I've been buying with more conviction has been Hershey and spirits companies. That I think that's part of his following question, right?
Yeah, exactly. What are your thoughts on the current valuation of beverage companies? I think you touched on this also a little bit already.
Yeah.
Good. Then we have two questions from which are quite similar from Invertir and Dividendos and Floppy Stonks. And effectively, the first one asks about 2 or 3 of your Spanish favorite companies, and the other one asks your top 5 Spanish dividend stocks. Maybe if you could give 2-3 stocks in general that you say from a Spanish point of view, if people are interested to invest something from Spain, what stocks would they look into?
Yeah. Okay. Well, Iberdrola, we already discussed it, and I think it's probably one of the most known for foreign investors. I like Inditex, the owner of Zara, although it's a company operating in a sector that I don't like that much, but it's a company that has always been extremely well managed. It's been a very successful company, and it has grown dividend a lot. So I say Inditex. And then I like a lot a company named Viscofan. which is a small company. It does food casings, and it's very, very well managed company. It has grown the dividend for many years, and it's very interesting because it's the global leader by far in their sector, and it's a relatively small sector that doesn't grow much. And I think that's positive because that avoids the entering of new competitors. But they managed to be very profitable, and as I say, I think it's one of the longest streaks of dividend growth in Spain, and it's some sort of consumer staple company because their products are necessary for staples, and they are basic for them, but at the same time their price is very low, so they are able to steadily increase prices, and those competitors are not interested in change their supplier because price is very low, but the risk of something going wrong is very, very high. So it has high barriers of entry, in my view, and I think it's a very interesting company.
Nice. If you could send me the ticker symbol later, that would be awesome.
Yeah, sure. Sure.
Good. Then our friend Dividend Wave, one of those that I always check his earnings readouts because he's always very fast with this. I think he's teasing you a little bit, but he wants to know your thoughts on the PepsiCo capex and free cash flow that you both regularly debate.
Yeah, I honestly I was expecting this question because I follow what he posts on Twitter or X, and he always has very interesting posts, and he generally includes the evolution of free cash flow and dividend payout of several companies recently. And he's had some concerns in these past few years with the dividend payout of Pepsi. And I have always made some comments on why I consider that the dividend of Pepsi is actually quite safe. And the thing is the following. Pepsi, these past few years, as some other staples, has had a big capex cycle because they made big investments for increasing capacity in Africa and Asia. And the company generally used to have around 4.5% of capex as a percentage of revenue. In this past 5 years or so, this has jumped to 6% or close. But they already guided that this would go down to normal levels. So if you consider that Pepsi is a company that has over 90,000 million of revenues, even a point or a little bit more of a percentage point of revenue of less capex is 1 billion of more free cash flow. And also there is one thing that it's not only applicable to Pepsi, but to other several companies in the US, like Coca-Cola and many more. With in the last government of Donald Trump, there was introduced the tax a tax cut that it was called the Tax Cut Act, I think, and that law allowed many companies in the US to repatriate profits in the US by paying one specific amount, and those companies could pay that amount in several years until 2026. So Pepsi has been paying these past few years this amount, around 300 million euros yearly. And this last year, 2024, they have paid almost 600 millions. And for 2025, they have guided almost 800 millions. And I think that will be the last payment. So if you consider that normalizing capex, they will probably have over 1 billion free cash flow, and then that they have between 500 and 600 million more as a consequence of the end of these payments. then you would need to add maybe 1.6 or even 2 billion of free cash flow to PepsiCo. And if you consider both things plus what the business will grow, I think it's reasonable that in maybe 2 or 3 years, the company will be making close to 10 billion of free cash flow a year. In 2024, they paid 7.2 billion in dividends. So I think, in my view, I think the normalized payment for PepsiCo is more close to 80% than to what appears to be a payout close to 100%.
I said the only thing I'm a little bit worried about is not so much the high payout ratio, but generally the ability to grow the dividends, let's say in high single digits, as what we are used to. And because of that doubt, I feel like the dividend yield is not strong enough. You know what I mean? If you look for a dividend yield plus growth percentage, I still feel like Pep is a little bit more there from the expensive side from a dividend growth investor. I would need to have more current yield to compensate for my expectation, right, about the less dividend growth than what we have been used to in the last 5 to 10 years. So I'm looking still a little bit for revaluation there.
But dividend growth in the last 5-10 years, I think I don't have it in front of me, but hasn't it grown close to 6-7%? I think it has grown quite nicely. I think it's reasonable to have doubts on whether growth could be slower in the future. Although I think PepsiCo has a quite nice business that will be able to grow, but I think they have had a nice dividend growth rate.
Yeah, they had 6.15% over the last 5 years, but then for me, a 3.5%. I know it's almost 10, but it's still a little bit too low for me. For me, this is a company where I own shares, right? But taking all those things into consideration should be probably yielding more between 4 and 5%. That's where I would be looking at, and then I could be interested. I find it just a little bit too risky for me. Not saying that the dividend will be cut, but the way how I evaluate businesses, they're operating on a very, very thin margin of error that they have been given, right? So the good thing is, I think they have excellent management. Yeah. So management has been demonstrating this, but yeah.
I think PepsiCo will continue being a steady grower, and I think it's nice. I think there's something very interesting with PepsiCo, because when you may remember that when we came last time to the podcast, we were speaking about PepsiCo versus Coca-Cola, and I think there was a big consensus that PepsiCo was a way better business, and I think we are that we like Coca-Cola better, and to be honest, at that time, I remember joking with Eloy that if at certain point Coca-Cola stock would do better than PepsiCo, a lot of people would change their opinion and start saying that Coca-Cola is better. And if you go into Twitter, that's exactly what you're seeing now. You see a lot of people saying right now that Coca-Cola is a better stock than PepsiCo, and stock prices drive narrative a lot. And I think, of course, that the same will happen eventually if Coca-Cola stock drops and PepsiCo goes up again. But I think that
I'm not even looking at Coca-Cola. I'm not even looking at Coca-Cola, but
no, I'm not referring to you because
no, but that's why I don't see those conversations, because I don't even look at it on Twitter. It's like in my ignore mental ignore space. Yeah, but you're right. Stock prices do change the narrative, and I love to buy shares when the narrative against it, like Hershey. People are talking like Hershey was dead. I just started buying again. Yeah, so yeah, a good point. Pepsi, I was even thinking, are we discussing here the same? But again, I think this is what it is, right? Often with these kinds of things, it's not necessarily only the data that's telling us something. It is like, do you have conviction? And where does conviction come from? Conviction comes from understanding the industry. Conviction comes from liking their products or not. Conviction comes from many areas. Conviction also comes often from, have you been burned by something in the past and therefore want to stay away from it? Like, yeah. So what I have with banks, I've not been burned on banks, but I just don't like banks because of their nature of the business. Yeah. And I think that drives narrative as well, Alberto. It's
Yeah,
here.
of course, and also as we mentioned previously, there is a giant amount of different kind of stocks, and of course, you don't need to own every single stock.
Exactly.
And there are very good stocks that you can decide not to own because you are not comfortable or with the business or with the valuation or with the perspectives that you have, and that's completely fine.
Exactly. Two more quick questions. Your thoughts on Enagast quickly. What do you think, Enagast?
I dislike the company. I think it was a good investment for many years, and the dividend grew for several years very nicely. But I completely dislike that many of the decisions I think nowadays are based on political matters and not in favor of the best interest for investors. When I realized that, I used to be a shareholder, but I sold the shares, and I wouldn't own them because I do not have the trust that in management that the decisions are based on business purposes.
Yeah, agree. Joram de Roos asked also a question about, hey, a happy holder of Iberdrola. Would love to hear your thoughts, but I think you shared them already a bit.
Yeah.
Also in the same energy sector, again about UK green code wind. Is the dividend durable? I will not answer that question now because I would say usually I would say yes, but they just reported earnings and I've not read their earning reports. So, and as I do this once a year, I want to read first before I answer. That's I think what we as people on social media should always do. We need to know our facts and not say something without understanding them. So I first have to read the latest annual report. Good, Alberto. Hey,
great.
We did it very well. I mean,
yeah. It was a lot of fun, honestly.
Yes, we could speak for another 5 hours, I'm afraid.
Yeah, absolutely. That always happens when you share common interest and you have affinity. Like I think it's the case, at least from my side.
Definitely.
It's always a pleasure.
Yes. So thank you so much, Alberto, and I hope to get you one more time on the show again.
Sure. I will be willing to.
And maybe for people that actually don't know where to find you, where can they find you? How can they get in touch with you?
Well, I guess right now only in X. And I'm not really sure what my tag is, to be honest.
I know it. ALB_DGI. I will put it also in the show notes
great.
in the description. So people
to be honest, I'm not extremely active there. I post some things from time to time. I always say to myself that I have to be a bit more active. So we'll see. I will do my best.
Just go with the topic of the newsletter. Please promise us as a community that you won't suddenly silently retire and we will not get to hear you anymore. So I will try to keep you from time to time on the podcast or something like that, because
pleasure.
I think you're one of those people, I think, in the community, in the European community, that really inspires a lot of people. And thank you for that.
I mean, thanks a lot for your kind words and also for your invitation, and of course I hope I can come back anytime and to see also Derek here.
Yes, and then we can ask Derek a bit again about Coca-Cola again.
Yeah. No, we won't do that.
Good. Hey, thank you so much. Thank you also for all the listeners hanging out with us still at this time of the podcast. As always, thank you so much for your support. The community is amazing. The engagement is amazing. Also, all the questions today. And yeah, see you all next week again.
See you.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We're just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.